So on we go to Chapter 10, Financial Planning with Life Insurance. Life insurance, again, is a financial instrument. It's out there in terms of, for you, it's out there to protect you in the event that something unforeseen happens or something that could possibly happen, but you're trying to not necessarily prevent it from happening, but to help offset if something does happen. If you die so that your spouse ends up, or your beneficiary, your loved ones end up with something as a result of the loss of your life, for example, life insurance. Anyway, everybody kind of understands that idea, but the way it actually works when it comes down to it is that life insurance is that you pay premiums, and so the life insurance company takes those premiums that you pay, and what do they do with those premiums? These are funds that are coming in. They ship them out immediately in terms of what investing, and the reason that they do that, aside from it makes sense on an individual basis, you certainly would do the same, but the reason that insurance companies do that is so that they can afford to pay those premiums in the event that they have to pay out premium payout is in order to pay out for losses, for those catastrophes, for those hazards that occur, the things that floods and so on and so forth, or I shouldn't say for life insurance if there's in the event of someone's death. Anyway, you get the idea. So on we go. The objectives: define life insurance and determine your life insurance needs, distinguish between the types of life insurance companies, and analyze various types of insurance policies these companies issue, select important provisions in life insurance contracts, and create a plan to buy life insurance, recognizing how annuities provide financial security. These annuities are also typically through life insurance companies, and we'll get into that. Those are payouts over a period of time. So life insurance is obtained by purchasing a policy. You are a policyholder. The insurance company promises to pay a lump sum to a named beneficiary at the time of the policyholder's death, or sometimes while they're still alive. It all depends on what the insurance is for, what it's stipulated in the insurance policy. The primary purpose of life insurance is to protect someone who depends on you from financial loss related to your death. So you pass away, your spouse, your significant other, your beneficiary is paid out some portion of money to offset that loss, if you will. Potential uses of those benefits: pay off mortgages or debts, lump sum endowments for children. The list goes on and on and on. Additional income that you would not be available for, again, for your loved ones in the event of your passing, if you will. Mortality tables are this is the lifeblood of an insurance company, because what they're doing is that they're going through the likelihood. They're kind of the house, so far as like gambling is concerned. The house always wins. Life insurance companies always win. What I mean by that is that unless there's some major catastrophe like we talked about, something major where many people die at one time, unforeseen circumstances, but they're all covered by life insurance with given companies, then the insurance company has to pay out premiums for the beneficiaries, for spouses, etc. They're surviving beneficiaries. So again, mortality tables determine what are the odds of you living. If you're a 60-year-old male, what are the odds of you living to age 70, for example? And that's what the mortality tables are. It goes through that. It's based on age, sex, in particular, excuse me. And the next piece that we're looking at are premiums. The cost of the policy is based on your life expectancy and projections for the payouts of the persons who die. So if you have medical issues, medical problems, medical history, where there's some complications, chances are you might be able to buy an insurance policy, a life insurance policy, but it would be higher than would be for a healthier person. Things to consider. Do you actually need life insurance? Do you have people you need to protect financially? Are you single and have a lot of debt? Do you have parents, relatives, or a charity that you want to support? Is there somebody that you could identify that you want to help out? Estimating your life insurance requirements, the easy method, 70% of your salary for 7 years while your family adjusts. Assume typical family. The DINK method, dual income, no kids. Okay, this is very straightforward. Assume spouse's earnings are equal to the insured or greater than the insured. Cover funeral and half deaths. That again is the DINK method. We'll be walking through these. So, non-working spouse method, number of years until the youngest child reaches 18 times $10,000. Your youngest child is 10, and to get to 18, that's 8 more years. That's $80,000. To cover the cost of that child, if you will. The family need method, more thorough than the first three, considers employer provided insurance, Social Security benefits, income, and assets. So types of life insurance companies and policies. Type of company, stock life insurance, mutual life insurance. Stock life insurance owned by the shareholders, policy type non-participating, and mutual life insurance companies, policyholders, and they are participating. Okay, so again, in essence, that if you're a stock life insurance, you could have shares of stock in that company, and you don't necessarily have to be participating. Meaning having insurance through that company versus mutual life insurance is that you're a policyholder and you are participating. Therefore, you are owner of the company, if you will, and you are also have a vested interest in terms of having insurance policies with them. Stock life owned by shareholders, 75% of this type, most of them, in other words. Sell non-participating, non-par policies. If you want to pay the same premium each year, choose a non-participating policy with guaranteed premiums. So again, if you want to pay the same premium each year going forward, choose a non-participating policy with guaranteed premiums. Mutual life insurance companies, and these have shrunk over the years. I'll just leave it at that. But owned by the policyholders themselves. 25% of the policies are this type of company. Participating policy premiums are higher than non-participating policies, but you're part owner of the company as well, or you're an owner in the company. Part of the non-participating premium is refunded to policyholders annually in the form of policy dividends, again, because you are owner and policyholder with the company. Types of life insurance policy, term life insurance, whole life, group life, credit life insurance, endowment life insurance. Walking through those policies. Term life is protection for specified period of time. If you stop paying premiums, coverage stops. Simple, straightforward. Many types, renewable, multi-year, level terms, conversion term, decreasing term, return of premium term. Again, all different types. Straight life, pay the premium as long as you live. Amount of premium depends on age. When you start the policy, provides a death benefit, accumulates cash value. You can borrow against cash value or draw it out at retirement. Look carefully at the rate of return your money earns. Okay, this is the whole life policy we're talking about. Typically speaking, that rate of return is quite low for whole life insurance, but nonetheless, it's something where it does have a cash value, cash surrender value, I think is the actual term. So whole life policy options, limited payment policy, you pay premiums for a stipulated period, usually 20 or 30 years, or until you reach a specified age, 65. Policy then paid up and you remain insured for life. So you don't have to pay any more, but that's the limited payment policy. Variable life policy, minimum death benefit, guaranteed benefit can be greater depending upon earnings of the dollar invested in the separate fund. All these are different You can see why they're all different types of financial tools, if you will. And again, it can get quite complicated. Again, variable life, minimum death benefit guaranteed. Benefits can be greater depending upon the earnings of the dollars invested in separate funds. Adjustable life policy can change premium payments or a period of coverage as your needs change. It can go up and down. Universal life, it includes a term life policy with cash value. You can borrow against the cash value. Premium amount may be changed at any time without changing coverage. Part of the premium goes to investment account. Increase in cash value reflects interest earned on short-term investments. Group life insurance, this is through your employer. Typically, again, it's a term insurance policy through your employer so long as you're working for your employer. There's no physical required up to a certain point. After that, there typically is a requirement for a physical. Physical as in going to the doctor. Credit life insurance, debt paid off if you die, mortgage, car, furniture also protects lenders, expensive. It's an expensive type of protection. Endowment life insurance, coverage for a specific time, pays to the holder if still living at the end of the period. So again, it's setting aside life insurance, and if you reach a certain point, if you reach that golden age, you can start collecting at the end of at that time. Pays to the holder is still living at the end of this period. It may be set up for age 75 or something along those lines. So there are different types of life insurance, of course. There are term life, whole life, universal life, all these different options. They're all geared toward one thing or another. Term life, you're just paying for life insurance, period. Whole life, you're paying a bit more, but you're able to actually have a cash value that you can get from this after a certain point. You can take loans out against the policy, so on and so forth. The universal life policy, it takes it to another level. It's more flexible. Takes advantage of current interest rates, offers a possibility of improved mortality rates, increased life expectancy because of the advancement of medicine, which may lower policy costs going forward. At any rate, these are, again, it's very similar to whole life, but greater risk due to program flexibility, things up and down, and interest rates in particular. So key provisions in life insurance policy: naming your beneficiary and contingent beneficiary. So not just one, but more. The incontestability clause: after the policy has been enforced for a specified period, the company cannot dispute or can't dispute the validity for any reason. Length of grace period for late payments. Reinstatement of lapsed policy if it has not been turned in for cash. Again, this is just added benefits, if you will, for the policyholder. Non-forfeiture clause allows you to keep accrued benefits in a whole life policy if you drop the policy itself. So you're going to still end up with some benefit even if you drop the policy for whole life. Misstatement of age provision, meaning that if you state that you're 25 years of age and in fact you are 35 years of age, there's a penalty for that. Policy loan provision to borrow against the cash value. Suicide clause during the first 2 years, meaning that if you buy a life insurance policy and your aim is to commit suicide and so that your family will benefit from that, this kind of offsets that, meaning it pushes it out to at least 2 years before, sadly, you could commit suicide and your beneficiaries could collect. Policy riders modify the coverage by adding or excluding conditions or altering those benefits. Policy riders themselves: waiver of premium disability benefit, accidental death benefit, double indemnity. In the event of an accidental death, your policy pays out double indemnity. guaranteed insurability option, cost of living protection, aka inflation premium. Accelerated benefits, also called living benefits, paid to those who are terminally ill before they die, so that you can get that earlier. Second to die option, also called survivorship, ensures 2 lives. So, meaning that paid out to one or the other, but it could be paid out to another as well as you're going forward. Second to die option, also called survivorship life, insures 2 lives at one time. Buying life insurance, you should consider present and future sources of income, other savings and income protection, group life insurance if you can get it through your company, pension benefits, social security benefits, financial strength of the insurance company itself. So all these are factors that you have to keep in mind. Determine from whom to buy your policy. Examine both private and public sources. Research the companies. And the ratings are out there again. AM Best, Standard & Poor's, the typical financial credit rating agencies have these colleagues, or excuse me, have these the insurance companies listed, including Moody's, etc. So far as your insurance agent, ask friends, parents, neighbors for recommendation. Is the agent available when needed? Does the agent advise you to have a financial plan? Do you feel pressured? Does the agent keep current with changes in the insurance field? Does the agent belong to professional groups or is a chartered life underwriter, CLU, who require continuing education? Is the agent willing to take the time to answer your question and find a policy that is right for you? All these questions that you're asking. Buying life insurance itself, compare the policy cost based on the company's cost of doing business, return on the company's investments, the mortality rate among policyholders, policy features, the ability for the company to meet its debt obligations, and making sure that the company is actually solvent and will be viable going forward. Is it competitive with other firms? Is it in a very competitive arena? Typically they are. Nonetheless, interest adjusted index used to compare policy cost. The lower index equal lower cost policy, of course. First step is to apply. Second step, provide medical history. Usually no physical for a group policy. Again, read every word of the contract. 10-day free look period to change your mind. Give your beneficiaries and lawyer a photocopy of your policy. So onward, settlement options, choices of how the insurance money is paid out. Lump sum payment is the most common. Limited installment plan. So this is that annuity that we talked about, equal installments for a specified number of years after you pass away. 10-year certain, for example. You can go from there. You can go up or down, I believe, but that's typically what it's set at about a 10-year payout. Life income option, payments for beneficiary for life, kind of like a lottery. Scary. Proceeds left with the company, pays interest to the beneficiary. That's another way of looking at it, is that it's paying interest. It's interest only, basically being paid to the beneficiary. The 10 golden rules of buying life insurance. 1, understand and know what your life insurance needs are before you make any purchase, and make sure the company you choose can meet those needs. 2, buying life insurance from a company that is licensed. And anyways, the list goes on from there. These are all things that, again, you have to keep in mind. All things that, due diligence is the thing that comes to mind. Should you switch policies, switch if benefits exceed the cost of setting up another physical, paying policy setup costs, etc. The older you are, the higher the premiums. Are you still insurable? That's a big question. Can you get all the provisions you want, again, going forward? Financial planning with annuities. Annuities, remember, those are payments, regular scheduled payments going forward. Financial contract written by an insurance company providing a regular income. Can supplement retirement income and shelter income from taxes. Those who expect to live longer than average benefit most from annuities. Fully funded IRAs, KIOs, and 401ks fully fund them before considering an annuity. Reason being is that this would be that fallback on your IRA or your KEO or your 401k. Why buy annuities provides retirement income for life, compounded interest grows tax-free until money is withdrawn, no maximum annual contribution amount like IRAs, beneficiary guaranteed no less than amount paid in. No guarantees in life, but there's typically annuities are pretty good in terms of that. Types of annuity: immediate annuity, income payments begin at once, deferred payment begin at some time in the future. Fixed annuity, annuitant receives a fixed amount for life. Variable annuity amount received depends on investment performance. Index annuity, earnings rated based on stock market index, can be included in IRAs and the KEO plans. Interesting. The cost of those annuities, the surrender charge is charged if you withdraw your money within a certain period. Mortality and expense risk charge, usually 1.25% of the value of the account or the account value. Administrative fees, flat fee, $25 to $30 per year. Percentage is usually about 0.15%. These are administrative costs again. Fund expenses, annual indirect cost imposed by fund handling underlying investments. So there's administrative fees, and there are more administrative fees. The annual indirect cost imposed by funds handling underlying investment. Tax consideration of annuities preserves tax advantage of annuities and insurance. No maximum contribution. Beneficiary guaranteed no less than what they initially contributed. Again, this is there are no guarantees, but it's close. It's as close as you're going to get. Again, tracking through these objectives one more time. Estimation methods so far as like how much life insurance you actually need. Type of insurance companies, and walking through the other parts of this as well.